right, it's August 2021. This is our first annual update for our fiscal year. Just to remind everyone, our fiscal year runs from July through June. Wasn't able to get a video done last month, and so this is going to be our first one, even though, like I said, it's our second month in our fiscal year. I was really excited and really curious as to what was going to happen with this because remember our historical data did not capture the COVID drop last year, and so this year we put that historical data into the formula. I was really interested to see how the system was going to take this, and it did exactly what I expected it to do, but it did surprise me a bit. All right, so let me quickly show you what's going on. So this is let me do it this way. So this is, you see, ever since June 2018, this is assuming, right, that you purchased the companies in this portfolio and you held them from June 2018 till today, right? And if you did that, your return will have been 65%. Now, this is completely hypothetical. Reason being is because the companies that we had in our basket of stocks in June of 2018 were not the same. And the reason being is because there's companies that's in our basket of stock this year that were not investable in June of 2018 for a myriad of reasons. Number one, we only invest in companies that have been in business for 10 years or more. They've had to pay a dividend for 10 years without ceasing, right? So if there's even like one quarter that they miss paying a dividend, guess what? We can't invest in that company. And I go through this every single year. I go through the entire market and look for these companies. It's important for me to say too. So let me just keep going and do. So we only invest in companies that follow the U.S. SEC financial rules. And the reason why that's important is because the SEC stipulates how companies do their accounting and how they report their numbers, right? And so there's oversight from the SEC on this. There are some companies that are on the U.S. Stock Exchange that don't necessarily have to follow those rules, okay? There's also, we only invest in companies on the major U.S. exchanges, which means that if it's a company that is on the over-the-counter market, we cannot invest in that company, right? And again, that has to do with reporting, because if you're on over-the-counter, then you're not held to the same standard as a lot of these companies. And so what I've always wanted to make sure of is not only do we have continuity when you're comparing companies, but I also wanted to have some sense of security knowing that the numbers that we're looking at least have oversight, right, in the U.S. Versus some company that may be based in like Sweden or something, you know what I mean, or based in China, or, you know. So there's a lot of companies that we just can't invest in, Toyota being one of them. I love Toyotas, but we cannot invest in Toyota because Toyota is a Japanese company and they are beholden to Japanese rules. It is possible to invest in Toyota, like as a U.S. person, you can invest your money in Toyota through a U.S. broker. But again, like I said, they're not beholden to U.S. rules. The other thing is that some companies, what they call ADRs, and I forget what the acronym stands for, but an ADR is a stock that, again, you can invest in as a U.S. person with a U.S. broker, but you don't actually own a piece of the company. And it's really weird and difficult to explain, but when you purchase a share of Walmart, let's say, right, you literally own a piece of Walmart. You have ownership. If you happen to purchase like 5% of Walmart, you can get a seat on the board. You know what I mean? Like you can actually affect change at Walmart and in these companies. And that's something that I've always envisioned for Texas Investments. I don't think it'll happen in my lifetime, but it'll be really nice to have this continue to go and grow. And one day, maybe there will be enough cash in there where we can actually, like I said, get 5% of Walmart or some other company and actually affect change, because I really think that, you can do things politically, but I think having influence on the big corporations is really where it's at. You know what I mean? Because corporations have to deal with government regulation, but not so much. You know what I mean? So anyway, so that's what this means. And so what I did was, as you saw, I just kind of sorted this thing to get the largest return. And so what we're looking at is what portfolio is that, right? And so we see the M score down. I've talked about the management score before. A lot of that has to do with how much cash is on the books, because we like cash-rich companies. And so a lot of times what I'll do is I'll just kind of look at like the top 5, top 10, and just see what portfolio shows up the most in this group. And so without really just counting, just looking, you can tell like M score is kind of it. And that kind of makes sense, right? Because when you're talking about COVID, when you're talking about the market dropping, not only companies, but people, right? If you had a bunch of cash sitting in the bank, you were good. Who cares if your company lays you off? Who cares if whatever? Man, you got cash. You can go to the store and buy up all the toilet paper you want to. Go home and chill, And so the same thing happens with these companies as well. You know what I mean? They're kind of like, COVID, we got cash. We're chilling. Not only that, but remember, these companies that's in this basket of stocks, right? These companies don't miss a dividend, and they haven't missed one for 10 years, right? And so the only way to do that is you have to have cash. There ain't no way around it. You have to have cash, or you have to be able to go out and borrow cash. And so that's why we see this M score so much. So let's take a look at, now this is a rolling 12-month number here, all right? So that means the last 12 months. And so every month, this is going to change a little bit because it's going to drop the earliest month and add the latest month, right? Okay. And so that's what I've been going with, right? And that is down moves, which is interesting. I've talked about this before. I'll explain it again. Down moves is kind of like an RSI indicator, right? So it's using volume, right? So it says that if volume is above average, and I mean above average for that particular stock, right? So if the volume is above average, which means there's a lot of buying and a lot of selling going on, how often does that price drop, right? And so what the program does is it counts how many times the price drops whenever there's above average volume. And it takes the companies that dropped the least number of times, and that's where you get your down move score from. And so again, that makes a lot of sense, right? Because when you talk about the COVID drop in particular, you're talking about a lot of volume, because it doesn't matter if people are selling, doesn't matter if people are buying, it's just volume, it's just number of transactions. And so when you have a lot of transactions, which of these companies drop the least? Now, we do have an up score as well, and we see that way down here, right? And this is, again, when volume is above average, how often does the stock price increase? And so, like I said, we can see up moves is way down here. And we still see a bunch of M scores, management scores, is what I call it. Now, it is made up of other attributes other than just cash, but that's the biggest driver, honestly. So another thing that we want to take a look at here is the low and the high, and this is really kind of statistics, honestly. But what it does is it takes the average return, right? The average monthly return. Is it average monthly? Yeah, the average. Is it? Oh shoot. Yeah, it takes the average monthly return. There we go. Yeah, it takes the average monthly return, and then it subtracts the standard deviation. And the standard deviation is basically by how much does this portfolio move around. Okay. And so just to show you here, because this is always kind of proof of concept for me, just to show that, wrong way, to show that the program is working as it should, proof of concept, right? So these portfolios moved around the least. And of course, they're beta companies. Look at this. Beta, beta, beta. This STD, standard deviation, again, that's companies that moved around the least, right? Beta is a company that when the market in whole, right? So when the entire market itself, and remember we're looking at the Dow Jones Index, when that drops, let's say 5%, these companies drop only 4% or 3%, right? So that's what a beta is. And so, yeah, so we see a bunch of beta, and then we see some, beta, some standard deviation. So anyway, yeah, of course. So of course those portfolios moved around the least, right? Of course they did. And then when we take a look at the opposite end of that, right? What portfolios moved around the most, we get the infamous M score. And I want to say here, I've talked about this in the past, but probably not recently. M score is an attribute that I added to the program after forward testing it, right? So just to give you a little history, like I said, I started working on this in 2009, 2010. And yeah, it took me, 5 or 6 years to get it right. So, but what I did was, I created the software and then I back tested it, meaning I used the software and I assumed that, let's say in 2012, this was actually 2010. You know what I mean? And so I grabbed the data from 2010 and then I tested the program going forward from 2010 all the way to 2012 to see, how the program worked, and it worked fine. But then you have forward testing, and if you're not familiar with programming, so like when an app comes out, they call it a beta test, right? And that's literally what it is you're testing the application live, literally, because there's no other way to do it. You can back test something, but a lot of times there's biases in that, right? But forward testing that's just proof positive that it works. So I forward tested this for probably about a year or two, and then now I decided to add the M score as an attribute. And ever since then, I don't like M score. It's never it's never, those portfolios have never performed well. This is the first time that I've even seen the M score anywhere near the top. It's super weird. I'm not quite sure why. We'll look at that here in just a second. But as you can see too, um, this thing moves around a lot, moves around the most of any of the portfolios. And so that's the reason why I chose to go with the down moves as our target portfolio. I do want to take a quick look too at the high end. Let's see, largest. There we go. So yeah, so again, this takes the monthly average and then adds the standard deviation to it. Again, standard deviation is, by how much the portfolio moves around. And so down moves we see is way up there, just beats everyone by 3 or 4%. And I always like to look at the opposite because it kind of tells me whether or not what I'm looking at is real. And so there you go. So there's a bunch of our betas again. The return standard deviation again, right? And that makes a lot of sense because we're talking about, portfolios or companies, rather, stocks that have the largest monthly average return, but also don't move around a lot. Like the price doesn't go way up, it doesn't go way down, right? And so that's kind of why that's there. And so these are on the low end, right? These are on the low end. Another thing that I want to discuss here, because just in case you're wondering, 60%, 50% is ridiculous. I have not seen these numbers in the last 6 years. Haven't seen it. And the reason for that is because, like I said, the COVID drop, and then we had literally like a V-shaped recovery. I mean, the market just bounced way up. And I've talked about that in the previous video, specifically because we were trounced by the market this year. The Texas Investments has beat the market return every year except for last year. And it was just crazy. I think the Dow Jones returned something like 40%. And so, there's no way. And so that's the reason why you see these huge numbers. I'll say that it is an outlier. So if I see this second, third year, I can maybe say something different. But as of right now, it's an outlier. It's completely ridiculous. And so one of the things that I did was just to make sure that what I was looking at was not a fluke. As I went through and really took a look at what companies were in these portfolios, and also what type of return these companies were throwing up. So let me quickly get to our down moves portfolio. And here we go. So right away, so the number one company, defensive, this is in the same position with Campbell Soup right now, right? So purchase price as of, purchase price as of, I believe, June 2019. Not entirely sure. Can't look it up live right now. But anyway, so this is the purchase price if we had purchased it back then, right? And then this is the current price. And as you can see, it's not quite 100%, it's damn near 100%. Same thing with this financial company, IVZ. I mean, it's literally more than 100% return, like double your money. What's another one? So GLW, almost 100%. Emerson, almost 100%. I mean, it's crazy, right? And so, but I went through more of these portfolios again, just to make sure that we weren't looking at a fluke. I did not run a formula to get into the minute details of exactly how many companies we had above 100, how many companies we had above 50%. Just eyeballing it, I mean, you can see that it happened quite a bit. I mean, look at Paychex. See what I'm saying? It's not quite 100%, but it's close, man. And this is standard deviation. Same thing with I forget RY Royal. I think maybe it's Canadian Bank. Not sure. Um, yeah, Southern Copper, where we are right now. Yeah, almost 100%. Um, Philip Morris, people smoking a lot of cigarettes. IPG, literally more than 100%. So it's no fluke. You know what I mean? This happened a lot, just kind of across the board. Um, okay, and these are just random portfolios I'm pulling up here. There's Best Buy, right? Um, Yeah, and so anyway, so I decided, really no need to run any formulas. What I did do though was I took out just in case, just in case I come on. All right, here we go. Just in case, so this IVZ, number one, is a brand new company. Okay, I don't know anything about them, and so what I did was I took IVZ out of the basket of stocks just as a test, right? I took IVZ out of the basket of stocks, and um, and so what the program will do is it will simply replace IVZ with a different, with like this. So IVZ is the best company as far as a down move score goes, right? And so when I took out IVZ, the program automatically replaced it with the second best option. And even after I did that, down moves was still the best portfolio in the rolling 12 months. Of course, the return did drop overall. Like once I took IVZ out, any portfolio that had IVZ in it, the return just dropped. So instead of looking at like 60% returns, I think everything dropped to like the highest was like 40%. Um, but the point is that the down moves was still the best portfolio, like I said, in the top five, top 10 for portfolios. I could have gone further and took out some more companies just to play around, but I didn't really see a need, honestly, because like I said, just at eyeball level, like I said, pretty much across the board, these are not outliers. This is just what it has been for the last year. All right, let's see. I want to take a quick look at the market and kind of where we are. Um, so this is from month to month how these specific sectors are performing. So as you can see, last month in July, the basic sector improved by less than 1%. In August, it dropped by a little bit. Okay, and so the purpose of this is when we're looking at like when there's a decision on okay, what company do we put more money into? We want to look at like what sector is it in? What sectors are performing better right now? You know what I mean? And so that's kind of what this stuff is. So this is telecommunications. You see it's improved a little bit. The cyclical companies, this is where Best Buy is, have precipitously been dropping. So that's something to look at. Consumer defensive sector as a whole has been dropping. And again, this is not, a picture of the market in general. This is a picture of the companies in our basket of stocks. Again, let me also say, these are huge mega cap companies. These are the largest companies on the stock exchange, right? So these are 10 billion plus. Anything less than $10 billion market cap, we don't invest in. We only want the biggest of the biggest. And the reason for that is because I don't want this portfolio to move around, right? So I want to make money, not lose money. So I don't like those wild swings that you can see in those smaller cap names. Of course, it's really nice when those small caps, go crazy, right? And double in price. But then it's not a lot of fun when the market drops like 1% and your small cap is dropping like 6%. So anyway, energy, we all, I'm sure, have heard the story, seen the news. Oil and gas and whatnot. It's not doing so great right now. I think OPEC just agreed to I think actually increase production, and so that's always a problem for U.S. Oil and gas companies because it means that more gas coming from them means less demand from the U.S. companies. So we'll continue to monitor to see how it goes. One thing I thought was really interesting, there was a viral video of the Gulf of Mexico on fire. From my understanding, it was like a gas leak. I didn't read a lot into it, but I didn't see or read or hear about what company was responsible for it. Now, I remember when the Exxon Valdez leak happened, that's what they called it. You know what I mean? They were like, Exxon did it, you know? I remember BP had an oil spill. It seems like every time I remember of like a major oil spill happening or something like that, the company that was responsible for it was like named in the story. And so the Gulf of Mexico being on fire, I don't know what company is responsible for it. And so I don't know. It's kind of weird, but yeah. So oil and gas companies not doing so hot right now. The banks, yeah, precipitously dropping, and we're in that boat too with Regions Financial. I mean, Regions Financial was doing really good for us at the beginning, and then it's just the bottom fell out. And I think a lot of that honestly just has to do with the fact that banks, we're done with stimulus, we're done with a lot of the loans and stuff like that. And so I think this is just a comparison thing. You know what I mean? Whereas like a year ago, banks were flying high because there was all this new business. They were making all these loans, and now that's kind of gone away. So, but I think banks are still a decent place to be. Who knows what the future holds? There's a lot of talk about inflation, which is good for banks. The Fed has chose not to raise rates, and so that may have something to do with the reason why banks aren't doing so well right now. But yeah, I don't know. I think I've definitely seen increase in consumer prices. From my understanding, there's increase in home sale prices. Um, so I don't know. We'll see. We'll see how it goes. Uh, I press up instead of down. All right. Next one is a lot of financial stocks. All right, the health sector has actually ticked up a little bit, so that's pretty cool. Um, Another thing I want to mention here, like I said, every year we go through the market and we pick out these companies, and so I try to get as many as I can, but this year we only have one, two, three, four, five companies in the health sector to choose from. Really tough. And again, a lot of that has to do with the dividend. Um, that's really about it, honestly. I mean, you can talk about. I mean, yeah, because so what happens sometimes is if the price rises too fast, right? Um, then as the price goes up, if the dividend stays the same, the dividend percentage goes down, right? So if you're talking about like, okay, a $5 stock, the dividend is $1. That's a 20% dividend, right? But if the stock price goes up to $10 and the dividend is still at $1, now all of a sudden the dividend is 10%, okay? And a lot of that has to do with management. Management has the task of making sure that they come together and raise the dividend with the stock price. Now, sometimes what happens is management will say, listen, the stock price is rising, but we don't think it's going to stay up there very long. So I don't think we need to raise the dividend. You know what I mean? Especially because, like I said, I mean, the dividend is literally money coming out of the company's pocket, you know? So anyway, so yeah, so when the company is beneath that 2%, we don't invest either, right? And so that's really a shame because man, there are some companies out there where the dividend might be at like 1.5%, and maybe they raise it next month, right? Well, guess what? It's too late. We've already chosen the stocks for our basket, and we're not going to add any more. Just what it is. Um, and again, the reason for that is for continuity, because what you don't want is you don't want to have you don't want to analyze everything and say, okay, this is our target for the year, this is where we're going, and then 2 months in, you have like 5 or 6 companies that get added to the list that completely change all of the formulas, they change all of the equations, and now you're like, oh, well, now it looks like we need to go this direction. So we don't want to do that. Honestly, sometimes I think even changing direction once a year is too much, honestly. But that's kind of what we've been doing, and we'll continue to do that until we change it. Maybe every 2 or 3 years, maybe best, because, like I said, the program right now says down moves are better, and I know for a fact that is because the program is adding that COVID drop into the equation. Without that COVID drop, then we may be looking at, like last year, it was the return portfolio and the alpha portfolio that was performing. But, I think right now that's kind of where we are in the market. I think it's prudent to kind of stay safe. At some point, I imagine that we're going to be rocking and rolling again. Um, but again, I mean, I don't have a crystal ball, and I'm not even going to try to predict that. There's a lot of people out there that will. I have no clue. I just know where we are now. I know where we've been. That's it. All right. Next sector is the industrial sector, falling precipitously, and we've seen that with Fastenal as well. Look at Paychex down there. We were just talking about that huge return that they saw. I really like Paychex as a company. I can't say a lot about the stock, but just as a company, man, I love Paychex. They're really all right. Real estate dropping precipitously, and I don't know. Maybe that has a lot to do with the interest rates. I don't know. WP Carey did mention that right now they're seeing some of the slimmest spreads they've ever seen, and what that means is that, like I said, they borrow at 3%, and then they I don't want to say loan out, but they borrow at 3%, then they do deals, at 4%, right? So that's a 1% spread, and so they're saying that right now the spreads are tighter than what they have been, and so maybe that's the reason why the real estate sector as a whole is dropping a little bit. Keep our eyes on that. Lots of real estate companies this year. I don't know if we had that many last year. All right, technology, again, dropping precipitously. Not sure why. Again, maybe it has to do with those inventory backlogs and whatnot. And utility companies, lots of those things. And we do have a small tick up on utility companies. A lot of times, it's weather and that kind of thing. as to why you'll see that right now. We're in August. All of these are primarily U.S. Based companies. There are some that do business outside the U.S., but I think the majority do business in the U.S. I want to talk a little bit about, again, kind of what our target is and the specific companies in that target. So ETR is at the top of the list for utility companies. Reason being is because MVP, and just to explain what MVP is, if you don't know, every month the program looks at what portfolio performed the best. Okay, so this is a month by month thing, right? So this is not like the whole year or anything like that. This is month by month. So this month, this portfolio performed the best. Next month, the other portfolio performed the best, right? So ETR, 10 out of 12 months was inside the best performing portfolio. That says quite a bit. Now, it doesn't mean that this company is the best company. It doesn't mean that it even has the best return. It just means that, like I said, out of the last 12 months, from out of the last year, almost every time, right, ETR was involved in being in the best portfolio. So that's something that we definitely want to look at. Currently, we're in Xcel Energy, and it looks like even the average return is about the same as ETR. So I'll definitely do an analysis on both of these companies and decide kind of where we need to go. We don't have, let me think, we don't have a sales signal on Xcel Energy, but I think we can sell at a profit. So we may look at possibly getting out of that. The other thing that I always take a look at is that average return. Cheniere Energy, I think that is, CNP, has the largest average monthly return. So clearly they're doing something right. Maybe it's a fluke. I don't know, but I'll definitely take a look at it and see. All right, technology. The portfolio is calling for GLW, which is the MVP of the sector. Not by much though, because we got 4, 3, 2, 2, right? So, it barely beats out everyone else. But I mean, looking at that monthly return, you're like, wow. And then we got Hewlett Packard down here, which is where we are. Their average return is 5%. So we don't have a sales signal on Hewlett Packard. We are currently down in Hewlett Packard. So selling at a loss right now, I don't think is a good idea. Plus, Hewlett Packard has been doing well as a company, right? Again, like I said, I don't have a recent earnings call. Maybe there's one next month or next 2 months or something like that. But yeah, I mean, they're doing well as a company, so I don't think we're gonna leave them. But I'm gonna continue to monitor how Hewlett Packard stacks up against GLW, which I don't know a whole lot about, but they've been around for a long time. All right, real estate. The program is calling for, I forget, let's take a look. I think it's MPW. Yeah, MPW. I don't know anything about MPW. I definitely will have to do some research on them. We are currently in WP Carey. Talked about that. The average monthly return is 1%. And just in case you don't know, just to explain, when I say this monthly average return, so like I said before, all I know is where I am and where I've been. That's all I know. I don't know what's going to happen in the future. But what I can do is I can predict the future. And the way you do that is with statistics. Now, statistics say that an average is 68% likely to happen in the future, right? So if I were to predict what the next month's return for WPC will be, I could say that there's a 68% chance that the return is going to be about 1%, right? Now you do have to factor in the deviation because, like I said, the portfolio moves around every month, right? And so what you'll want to do then is you'll want to take that deviation and either subtract it or add it to that average, and then as you do that, you increase your chances of being correct, right? So one standard deviation away from the average of 0.95% will be something like I forget the exact number, but it's going to be something like 75% accurate, maybe 80% accurate, something like that. And then you can take it all the way up to 3 standard deviations, which is 99.5%, right? And at that point, trust me, to be 99.5% accurate about something that's going to happen in the future means that the variation in in return is going to be crazy. It's not even going to make sense, because you'll be like, well, I can be 99.5% sure that the return next month is going to be somewhere between negative 10% and a positive 8%, right? Like, that's crazy. But we do like looking at the average because the average, like I said, more or less is likely to happen. All right, so WPC is where we are. We do have a sell signal on those guys, and the program is calling for MPW, which again has really been an MVP in the sector. The other thing to take a look at though is SPG, which has this huge return. And again, I want to take a look at that, see how much the portfolio has moved around, make sure that it's not just some fluke that their return is that high. So again, we're looking at MPW, SPG, and WPC. Maybe I'll take a look at Well too. I forget the name of the company, but I've researched and known them well. They deal with health real estate, so they invest in like hospitals and outpatient centers and things of that nature. Their return looks really good, and I've always liked that business idea of owning health real estate because it ain't going anywhere anytime soon. And I think even though hospitals are primarily utilities, I think they're really good about paying their bills. You know what I mean? So anyway, moving on to industrials. So as you can see, Fastenal is where we are. Definitely the MVP of the sector. Looks like IRM, which is a new company for us, and EMR, which I think is new. I'm not sure. I don't know a lot about them, but they definitely have a larger monthly average return. So I'll take a look at there too. We don't quite have a sell signal on Fastenal, but we are definitely up in a position so we can sell at a profit and then possibly get into one of these other companies. And like I said, a lot of this is going to have to do with cash management. So like if I can buy more shares, let's say of IRM, then it may make sense to sell out of Fastenal. Like Fastenal is like $50 a share. If IRM or one of these other companies are like $6 a share, you see my point? Then I can buy a lot more shares and do a lot more with that position than I can with Fastenal. So I'll take a look at that. All right, healthcare. I forget. Let me see. Okay, CAH. Don't know anything about those guys. I'm pretty sure as soon as I see their name, I'll be like, oh yeah, those guys. Because like I said, these are the largest in the country. But definitely, what was interesting here is that Merck actually shares the MVP with these guys, and Merck is where we are now. We don't have a sales signal. Matter of fact, I think we're slightly down, I believe. And Merck, we're either slightly down or slightly up. I forget, but we definitely don't have a signal for them. Looks like CVS just blew everyone out of the water as far as return goes. I'm pretty sure a lot of that has to do with COVID, being that CVS was like, what they call it, essential, right? But with that being said, just looking really quickly at last month's return, I mean, they were down 4%. And like I said, they just, again, it's proof of concept, right? That goes back to what I said before about how a lot of these COVID companies that did really well during COVID, now their numbers are being compared with last year, and they're just not holding up. You know what I mean? And that's just the way it works, man. It's what have you done for me lately? You know what I mean? If I made 50 grand this year and I made 70 last year, guess what? I'm not doing great this year. That's just the way it is. That's the way it works. And so that's what's happening with a lot of these companies. So anyway, I mean, based on this very simple information, I mean, it looks like we'll just stay in Merck. I will do a little bit of research on CAH just to kind of see what those guys are about. But I think we're going to stay in Merck, at least for the time being. If something changes, we'll deal with it then. But I don't think we're going to do anything this month. All right, financial services. There is a bunch of banks in our basket of stock. Reason for that is because the banks have big, juicy dividends. And that's why we have so many. All these guys are above 2%. So IVZ, not necessarily the MVP because Blackstone is closely behind, a company that we've invested in before. I really like Blackstone. I really do. Just as not only a stock, but also a company, even though I'm a little, what's the word I'm looking for here? I over the years, because I'm in the industry, I've come to dislike the big financial advisors, the big financial companies, because I'm a small company. Number one, and number two, like, man, I can go on about this for a while, but like, government regulation says that some companies are required to offer their employees retirement 401ks, which it sounds great on the surface, but then you realize that what's happening is these companies are just funneling all of this money to these big financial advisors that, please understand, they don't have a choice. They have so much money coming to them literally on a daily basis. They have to put it somewhere. They have to. See, and that's the problem, right? They have to put the money somewhere. And like I said before, if you are if you're a serious financial advisor, man, guess what? There ain't that many places to put the money because you're thinking to yourself, okay, what are the best companies, right? What are the best sectors to be in? You know what I mean? And when you do that, guess what? It ain't 100. It's not 300. It's not 500. And so, man, when you go through like the holdings of a company like Blackstone, it's staggering. And they're also involved in a lot of real estate and stuff like that too. But anyway, so we're in Regions Financial, which has this huge average return, really on par with the rest of the banks, which I think says a lot about the financial industry. I mean, just going down the list here, yeah, everything is crazy. Everything is above like 3%, 2%. So like as a sector, the banks have performed the best over the last 12 months. Just no question about it. And so being able to then pick out the best performing company from the sector, I'll say is definitely going to be difficult. But like I said, the portfolio cost for IVZ, I don't know anything about the company, so I'm definitely going to do my research. We don't have a sell signal on RY. I think I explained before that technically we can sell out of the position and not lose any money because of the money we made on the options. But outside of just doing some surface level research on IVZ, we're definitely not going to move anywhere right now. I'm going to wait and see. Like I said, the stock price right now is at 20. Our purchase price is 26, and it was, it was like just there not too long ago. So we'll wait to see what happens. Maybe we'll sell some options to make some money that way. But I definitely will do some research on IVZ. All right, so energy. I believe the portfolio is calling for Valero. Yeah, sector NVP. Again, 4% is definitely on par with the rest of the industry. Actually, a little better than average. I'm kind of curious. Let me just see what that. Wow. So yeah, the average is 3%. So yeah, I'll say it's on par with the rest of the sector at 4%. So we're definitely not going to go anywhere. The program does not call for very many shares of Valero, and I'm sure that has a lot to do with just the energy sector as a whole, right? I think the energy sector moves around quite a bit compared to the other sectors, you know what I mean? And typically, I think when there's a lot of buying or selling in the energy sector, oil and gas, a lot of times it's people selling out of it, you know what I mean? Because they're concerned about gas prices going down, or they're concerned about having too much supply of oil. And that's just been the story over the last, probably 3 or 4 years. You know what I mean? The story surrounding oil and gas is always, oh, how much supply is it? Gas prices are so. I'm sure that's why the program does not call for investing so much in the sector. But you can't argue with the monthly return, though. All right, consumer defensive. We are in Campbell's Soup. I'm looking for. Now, I'm kind of excited because I believe last year or year before last, we had hardly none consumer defensive companies in our basket of stocks, and now we got a bunch. So that's pretty cool. So there's a lot of new companies in here that I don't know anything about, but I am interested in getting to know them. First, like BG. All right. So NWL, I'll say is the sector MVP. Definitely a decent average return. Don't know anything about the company, so I'll definitely do some service level research on them. See here. So Campbell Soup actually has a negative average return, which makes sense. Like the largest is this BG with 6%, but that's not going to warrant much attention from me, just unless I get curious enough about it. But I am curious about NWL at almost 5% average return. Looks pretty good. We're currently down at Campbell Soup, so I don't expect to make any moves anytime soon. Definitely don't want to sell for a loss. I'll definitely have to see like something bad happen before I make that move. Plus, like I said before, Campbell Soup is being compared to last year's numbers, so we're talking about waiting until almost a year from now. Honestly, almost a year from now, so that the new numbers are then compared with 2021 numbers, and then we can really see kind of where we are. Who knows what the price action will be between here and then, but that's kind of where we are. All right, consumer cyclical. This one is interesting just because we do have uh, uh, a a sales signal on Best Buy, um, and so the program is calling for International Paper. Make sure, yeah, and and so it's a company that I've known for quite some time. Um, Looks like the average return is on par with the rest of the sector, I'll say. Best Buy is not. It definitely looks like it's under average, and it's really weird because we're talking about a sector MVP, but the program is calling for IP. So I'm definitely going to do an analysis comparison between Best Buy and International Paper, and really make a decision on how we're going to go forward with that. All right, telecommunications companies. Last year we had quite a few. This year there's only 5. We don't have a lot to choose from. AT&T, sector MVP, but their return has been abysmal. I believe the program is calling AT&T. Yeah, the program is calling for AT&T. But I do want to make mention of this because I don't think I have before. These companies in this portfolio, they're all they're all sorted, right? So that the highest score, okay, is at the top, and the lowest score is at the bottom, right? And so what happens is the program says, all right, well, since this one has the highest score, then we're going to buy more shares of that company. Okay. And just kind of show you what that looks like real quick. All right. So here are the test shares. All right. Now, of course, this is based on the amount of cash that I tell the program I have available. Okay. And so for this particular portfolio, the total cash available is 5,900. Okay, and that's going to be about the same for all the portfolios. Some a little less, some a little more. So what the program has to do is it has to figure out, all right, I got $6,000 to work with, right? So based on that, how many shares do I purchase of these companies in order to give me the best possible return, okay? And so AT&T, you see, is at the very bottom, right? So this particular portfolio is calling for only 4 shares of AT&T, okay? So I don't feel any sort of way about not even looking at this particular suggestion or advice for AT&T specifically because, like I said, of the abysmal average return, right? So we're currently in Rogers. I like Rogers as a company. I really do. I want to see what happens with the stock price as we come out of this COVID thing. Whether or not we will ever see full arenas again at this point is hard to fathom. I mean, I don't know what to say about it. I've talked about this ad nauseum with friends and stuff, and I don't know. I don't know. Will we ever see full arenas? I don't know. But I am really interested to see when it happens because I'm sure that it will happen again. It's just going to take some time. So, again, we don't quite have a sales signal yet on Rogers, but we are currently up in a position. So we're just going to hang out there, not going anywhere. Even like it's on par with the rest of the sector as far as the average return. I'll keep an eye on it just to make sure it doesn't get away from us. But I'm definitely not going to go into AT&T. I don't even like AT&T's like business thing. You know what I mean? Like I think that like satellite and cable, I think it's gonna go away. I really do. I don't even understand how and why people are still paying for it. Honestly, I really don't. Everything is online. Everything is online. there's no need for cable or satellite. I can't imagine. So, and that's a big part of their business. You know what I mean? Like they do for sure have phones. They do for sure, cell phones and stuff like that. But a large part of their business is the cable and satellite and stuff. Whereas Rogers Communication is I would say the portion of TV and that kind of thing for Rogers is compared to their sports stuff, which I think is far more interesting and possibly far more profitable than any sort of TV packages. So anyway, so we're going to stay there. All right. Last but not least is the basic sector. Um, so this is interesting. I didn't see this before, but so the program I believe is calling for EMN. I think, yeah, EMN. And we are currently in Southern Copper, which pretty much now I'll say that there is no sector MVP for the basic sector because it is so spread out. You know what I mean? 4332 is spread out, which means every single month, there may be a different company on that list. Not only that, but Southern Copper is like it beats out everyone else as far as average return. And I think it's a more simple, direct uh, company to analyze and go with. Now, I believe we have a sell signal on Southern Copper. Okay, no, we don't quite have a sales signal yet. Now we did though. I think last month, a month before last, we definitely had a sales signal on Southern Copper. So I'm gonna actually just wait. You know what I mean? Once we get a sales signal, if we get a sales signal, um, then then I'll look at possibly moving. But for now, we're definitely gonna stay there. All right.